For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, what do you say? Shall we manage your financial future?
Always.
Why not? I mean, it's the title of the podcast. Welcome, John Dean, your podcast host, Professor Rick Plum, certified financial planner professional, accredited wealth management advisor. I got that down. I'm not even going to say
Not
it
even
anymore.
with the cheat sheet anymore.
No, I don't. The cheat sheet was a big help.
For a while.
It was. But anyway, we are managing your financial future. I'll say Happy New Year again. I feel like I should still say it.
It's only been a couple weeks.
It's been a couple of weeks. You can say it all the way through the month of January. February, you're kind of pushing it. If you're still saying it in March, forget it.
And then people are starting to get ready for the next Christmas already.
Yeah, they probably are. No kidding. They were talking about taxes. This is actually a good topic to talk about today, Professor Plum, I believe, because, I've found, and a number of years ago, I found that thinking about taxes in January, let's say, was a big help to me as far as planning goes,
Well, a lot of people start thinking about taxes in late February, March, when they file their tax return for the previous year.
Yeah.
They complain and moan that they have to pay, and then they don't do anything about it, and they're in the same cycle for the next year, and they have to pay again. So January is a great time to sit down and get an idea. I mean, if you have a fairly stable income and you always get a refund or you always pay, and you don't like always having to pay, now is the time to make the changes in your withholding so that over the year, you spread it out over 11, 12 months of
you're not going to
a
notice
little bit of
much
difference on a paycheck versus, doing it later in the year. On the other hand, if you're always getting, large refunds, you may not want to get that large refund. Maybe you want to have a little bit of extra money in your check. And now that their banks are actually paying a little bit of interest, you could be earning interest on it. For a while, it didn't really matter that much because the banks weren't paying any interest anyway.
You weren't missing out on anything.
Yeah,
but now you may be.
Hey, you may want to say, you know what, I'm going to try to get a little closer to break even so I have more in my paycheck every month rather than getting a big refund at the end of the year.
Although, some people, I know one person who just loves, it's like a bonus check. They just love getting this refund. Well, it's in the neighborhood of $4,000 every year. And they're like, this is my vacation money, or this is
right. Well, that's
my
a forced
fun
savings.
money.
I have done that on purpose. When my youngest was going to turn 16 a year later, her birthday's in April, and that's about the time you get your refund, right? And when she turned 16, I wanted to be able to get her some wheels because I didn't want her driving my car.
No.
And so I gave myself a forced savings plan. I increased the withholding on my paycheck every month so that I would get a refund equal to roughly what I was figuring on spending on the car. And filed my taxes in early March, got the refund late March. And by the time she was eligible to drive, she had her own car to take care of it. She learned how to take care of it, learned how to keep it clean, change oil, change tires, do all that kind of good stuff.
Well, let's talk about taxes, shall we?
But taxes are hopefully a way of life.
Well,
now, why do I say hopefully? Because the only way to get out of taxes is to have almost no income.
Yeah.
And that kind of sucks too.
Or just have a ton in your Roth accounts, which
that'd be nice, but you had to pay taxes to get there. But hey, it could
either
work
way.
out.
How are different types of retirement income taxed? I don't want to, we're not going to spend 10 minutes on each thing. We don't have that kind of time anyway. But I think it's important to know this if people are trying to plan their taxes this year. The types of income I'm talking about, Professor Plum, now this is retirement income. We're talking about, say, Social Security. We're talking about pension income. We're talking about personal things like, in your personal accounts, like annuity payments, capital gains, interest, dividends, all that kind of stuff. And maybe some Roth accounts, and tax deferred accounts.
Well, what I talked about earlier is I tailored my tax return to give me a desired outcome. And what I was talking about just for everybody was tailoring your withholding to get a desired outcome. But tailoring that, basically tailoring your tax return requires understanding what goes on that tax return and doing a projection of, okay, these are all the things that are going on the tax return. How much in taxes am I going to owe?
Yep.
And then, okay, how am I going to make those payments. Do I want to do quarterly payments? Do I want to have it withheld from certain, payments like an IRA payment or my work, whatever, sometimes some things you can withhold from, some things you can't. So how do we do this tailoring? And what I was doing, my income was fairly stable at that time. So I knew what my income was. I didn't have any, unfortunately, large one-time capital gains, darn it, that would throw my projections way out the window.
Yeah.
Of course, if I had a $100 million capital gain that gave me a huge tax, I would have had the money to pay the taxes at the end of the year anyway.
Would have been okay
and
with that.
Still buy the car in that example. But
you would have been fine. You would have been fine.
So when you're doing this, understanding where the income is coming from and then trying to estimate what else may happen becomes the issue. Now, for some people, especially retirees, their income is fairly set. Their income is fairly straightforward. They have their Social Security, they have their pension, and they are taking money from their traditional IRAs, and it's about the same every month. So they're very straightforward, and they don't have a lot of personal money that is earning interest, capital gains, and other things. The wild card in the tax projection are personal accounts. Everything else is fairly straightforward, but the personal accounts can really get wonky if you have large personal accounts when it comes to projecting your tax liability. Because if we look at the other types of income, the Social Security, we know what the Social Security is, especially if you're already taking it.
You know what your payments are.
You know what your benefit is. If you're getting a pension, you know what the pension is. Now, for most people, the pension is taxable. If you're getting $1,000 a month in pension, that's $1,000 a month that goes on the tax return, and it's taxed as ordinary income. It's just a regular, ordinary type of an income tax. So we know we've got that on the return. The Social Security we'll leave for later because how much you have to pay on taxes on your Social Security depends on everything else that may or may not be on the tax return.
Yep.
So we have to find out what everything else is, and then figure out how much of the taxability of the Social Security goes on the tax return. So we look at what else is on there. We've got our pension. Are we taking money from our IRAs, traditional IRAs, 401ks, tax-deferred retirement accounts? That income is an ordinary income, just like your pension. Makes sense. A pension is retirement income. An IRA provides retirement income. Same thing, right?
Yeah.
And so it's what we're looking at. And then you look at, okay, what other incomes do I have? Am I working part-time? Do I have part-time work? Is it very stable or is it up in the air? Where else can income come from? It can come from a lot of different sources. But the first places you look for are the ones that are known, the Social Security, the pensions, and your projected IRA distributions. Mm-hmm. And if you're doing conversions, those too.
Well, and that's why there are so many of these, which we're not going to spend a lot of time on every individual one. But this is part of the planning process.
But typically the retirement incomes are fairly straightforward and fairly well known. You know what you're going to be taking on a monthly basis from your IRA for the most part. You know what your pension is. You know what your Social Security is. Like I said before, though, the hard one is that personal portfolio.
Now, explain what you mean by that.
A personal portfolio is one that is not in an IRA, not in a retirement account, not in an annuity, not in something that is deferred, tax deferred, or tax free.
So, are you talking about, say, you've got
I've got a stock
account,
portfolio.
an
I've got
equity
a Schwab account that's got Qualcomm stock in it and Nvidia or what, pick your poison that's out there. I've got some cryptocurrency. I don't know what you got, but I just hold it in my own name. It's in my name or my spouse's name. Or if I have a living trust, it's in my living trust name. It is not sheltered from any taxation. Whatever it earns is taxable when it's realized in the year that it's earned realized. So, and what do I mean by realized? If I buy a stock for $10 and it goes up to 15, and I still own that stock, yes, I have a $5 gain, but that's not a real gain yet. That's what they call an unrealized gain because it's still paper. It could go down. It could go up. I haven't sold it. So even though it looks good on paper, by the time I get around to selling it, it could go down. And in my life, that's what happens anyway, because that's Murphy's Law.
That's you.
But once I sell it, then that becomes a realized gain. Now it's no longer a paper gain. It's a real gain. They call it a realized gain. I bought it for 10. I sold it for 15. That $5 is a gain. That goes on my tax return, that $5 gain. And so now we have to look at, okay, if we have a personal account, how is that personal account invested? Maybe I've got the proverbial $1 million in my personal account. Wasn't that nice, right?
Lovely.
300,000 of it is in T-bills. That's my bucket number one. I've got treasuries. I've got CDs. Well, right now that's earning a little over 4%. So that's $12,000 in interest. 300,000 times 4%.
Yes.
$12,000 in interest. Whether I spend anything out of that $300,000 treasury T-bill CD account or not, I'm paying taxes on the earnings on it. That's going to happen. I don't have to spend it to be taxed on it. I don't have to withdraw it to be taxed on it. It happened, therefore I'm taxed. It's just
therefore I am. It happened, therefore I'm taxed. Yes.
So we're looking at, so that 12,000 is now on the taxable income column. Then what else do I have it invested in? I've got 300,000 invested in a balanced fund, mutual fund. A little bit harder here because I'm not going to take anything from that balanced fund. I'm going to leave that balanced fund alone. It's going to grow, I hope, over the next year.
Again, this is all personal money.
This is personal money. This is not in an IRA. And if it grows, maybe I have 300,000 in that balanced portfolio, and it grows to 360,000. Wouldn't that be nice? That's a 20% return.
That would be great. Yeah, don't count.
Okay, well, let's go 330.
Let's just say
make
it
easy math. 330. Am I taxed on that $30,000 of growth? It's hard to know in a balanced portfolio because that balanced portfolio has some stocks and it has some bonds, and so the bonds are throwing off interest. I'll be taxed on what that interest is bringing quick. On those stocks, I may or may not be taxed on the stocks because the stocks may or may not be sold during the year.
Wow. Now this is really, okay. So
it makes it very, like I said before, the personal account is the wild account. Or maybe I've got go back to the proverbial $1 million stock account. If it's in mutual funds, I have no idea what the ultimate taxability is going to be because I may have $1 million at the beginning of the year. January 1st, 2022, had $1 million in stock mutual funds. What happened in 2022?
Well, we saw it go down.
So maybe I had 850,000 at the end of 2022.
But they were redeeming a good number of those shares.
But inside the mutual fund manager was buying and selling all through the year. And some of those things that they were selling were things that they'd purchased many years before.
With a lot of gain.
And with people wanting out of the market in 2022, the mutual fund manager may have had to sell quite a bit to be able to raise the cash to pay out the people leaving. And so I come around to, tax time, early 2023, when I'm doing my 2022 tax return, I lost $150,000 of value and I get a 1099?
As from a gain.
That
you
shows
never realized.
I have capital gain distributions that happened at the end of 2022. Wait a minute. So it's really, we have to pay attention to what you're invested in and how you're invested to try to get an idea, to get a handle on what's going on here.
It sounds to me like we're saying it's impossible.
It's not impossible.
My gosh, you know what? I was trying to see,
it's
how
not
is
an exact science.
How is your retirement income taxed going? And you're trying to project this from early on in the year. And I thought, we have to figure this out.
For most people, it's fairly straightforward. I know my Social Security, I know my pensions, I know my IRA distributions, and I don't have the $1 million personal stock portfolio. Darn it! I've got $100,000 and it's in treasuries and T-bills. I know what my interest is. That's really straightforward. Now we can calculate. We can go through it. We can say, okay, you've got your $12,000 here of pension. You've got your $12,000 from here, and you're taking $2,000 a month from your IRA in addition to your Social Security. Now, because we know the incomes that are there, we can calculate how much Social Security. We can get what they call your adjusted gross income. We can tell what that is. We can tell what your all the deductions are. We can come very close to what your taxable income is and say, okay, your taxable income is going to be $5,000 this year. So when you're taking that $2,000 a month out of your IRA, maybe you want to withhold $480 a month.
So you don't have to write a check.
So you don't have to do a quarterly payment.
Yeah.
And that way you've withheld $5,000 for the year, you've paid your federal income tax.
So you mentioned pension income.
Yes.
It's
primarily taxable as ordinary income.
Is it ever? It's as if you earned it. But I mean,
well, you did earn it. You worked your tail off for that company that's paying you that pension.
Yeah, somebody asked the question. I know the answer, but they said, "Well, wait a minute. If this is like partially, from something I did at work, does this mean I'm also paying FICA and Medicare taxes on it?"
The good news is no. You do not pay Social Security tax on any deferred earnings and deferred things. The money that's coming out of your pension is not subject to FICA, Social Security taxes, self-employment.
Right.
That's just
pension.
It's got enough taxes on it. You don't need to pay more.
Pension income is ordinary income. Now,
for the most part, there are some pensions, disability pensions, if you're disabled. Some, not all, some are tax-free. VA pensions, many military pensions have a portion, if not all of it, that is tax-free. But anybody who I've ever talked to that has one of those knows exactly what percentage of their pension is and is not taxable.
Roth accounts. Now, you would think that when you talk about how are Roth accounts taxed, well, I mean, if you follow the rules, there really shouldn't be any taxes.
Right. You don't have to worry about them. If you can set yourself up to get to what they call qualified distributions, and qualified distributions are any distribution after you reach age 59 and a half, and you've had a Roth IRA, any Roth IRA in existence for at least 5 tax years.
Yes.
And so once you've hit the 5-year and 59 and a half, threshold, then any distribution from your Roth IRA is going to be a qualified distribution to be tax-free.
Yeah, and that's the best part of the Roth, obviously, and the reason
that's why you have Roths.
you do those. Your tax deferred accounts. I'm talking about your IRAs.
IRA, 401k.
Now let's talk about how those are taxed briefly.
Those are tax deferred accounts. I was able to put the money in up front and take a tax deduction up front. The money inside the account during the growth period was sheltered from taxation. I don't have to worry about that realized, unrealized gain thing I talked about earlier. It's inside the IRA. It doesn't matter. It's kind of like Vegas. What happens in there stays in there. And then when I take money out, I guess is when I leave Vegas, then it becomes a problem.
The hangover is
when you take money out of the IRA, the 401k, 4057, 401a, 403b, there's a lot of them out there.
There are too many of them.
That will be taxable as an ordinary income, just taxable like anything else. So like I said, retirement incomes are fairly straightforward. They're all ordinary income. Annuities, if I have personal money not inside of an IRA, and I just put money into an annuity, whatever the growth, now they are tax deferred. So if I put $100,000 into an annuity and I let it grow for several years, and now,
we talk about any type of annuity,
whether it's a fixed annuity, fixed index annuity, variable annuity, whatever it is, if it's a non-qualified annuity, the growth in it is tax deferred if an individual owns it. So I put in 100, and years later it's worth 150,000. Although I was talking with somebody the other day who bought one in 1984.
Really?
And they put in, I think, $100,000 or so.
And they've
never taken a dime out of it.
It's been growing for 40 years.
And it's worth $1 million now.
Wow.
And they're like, I can't touch that money, can I? Well, you can have the money all you want, but it'll be taxable, because to get money out of an annuity, the first money that comes out of the annuity is that deferred growth, that deferred income.
That's what we call
LIFO.
It's called
last in, first out.
First out. Yeah.
So on my more normal example, I put in $100,000. Years later, it's worth $150,000. When I start taking money out of that account, the first $50,000 that comes out is taxable, ordinary income. Whenever you have a deferred account, the distribution is ordinary income. If I can do things, I can move things from different variable sub-accounts. They're kind of like mutual funds, but variable sub-account to variable sub-account, and not realize the gain when I sell one versus the other in an annuity. That's deferred. I'm going to pay ordinary income when it comes out. So you have to look at it. But if I've got $50,000 worth of growth in it, and I need $80,000 this year, I can surrender that $150,000 annuity and pay tax on $50,000 and do anything I want with everything else.
Yeah, because that was your original.
That was my original basis. It's what I've already paid tax on. So understanding what we have, where the taxable events are, what's going on, once you have the information, we can make pretty good projections.
But it can be darn hard, as we're finding out over the last 20 minutes, to actually get that information in many cases. How do I know my
when they're tax deferred accounts and they're retirement accounts? Life is pretty straightforward and easy. The wild card is that daggum personal investments that may or may not be taxable and are taxable if an event happens, whether you spend the money or not. With an IRA, realistically, most of the people leave the money in there until they take the money out and spend it.
Yeah.
So it's not taxable until they spend it.
Yeah.
With a personal account, it's taxable whether I spend it or not, if it earns it. And so we have to look at what that's doing.
It can be confusing.
And that's one reason why with personal accounts, I try to, if we can afford it, stay away from mutual funds so we don't have that problem of not having any tax control.
So you would rather somebody not own a mutual fund personally?
Personally, I'd rather have an ETF, exchange traded fund, or individual securities where we buy and sell individual securities, but we're in charge of buying and selling them.
You're in control.
It's not. I'm not worried about what the market does. If the market goes down, I just won't sell. I don't have to worry about a bunch of other yahoos selling and giving me a tax bill. I'll only get the tax bill if I sell or the tax loss.
It can be a problem, as you mentioned a little while ago, with owning mutual funds personally.
Mutual funds in a personal account. I remember when I first got in the industry years and years ago, the whole idea was you never buy into a mutual fund towards the end of the year.
Yeah, because they're getting ready to
because they're going to make a capital gain distribution. Yeah. All the goings on, everything that would happen through the year, the buys and sells that mutual fund did through the year, they issue the taxable event capital gain distribution end of November, beginning of December. So I could buy in November, and maybe I buy in at $10 a share. They issue $1.50 a share long-term or capital gain distribution.
Yeah.
And then I reinvest that money, and I still have $10 a share, because when they issue a $1.50 capital gain distribution, the share price goes from $10 down to $8.50, because $1.50 left the mutual fund and then went back into it as a new purchase. So I still have only $10 invested. My value at this point, I'm assuming no growth at the moment, my value is $10, but I got a dadgum tax bill on $1.50 a share.
The problem is the surprise. Now it's not going to affect you. I mean, in the end, it's going to affect your basis, so that when you sell out of this mutual fund,
it adds to my basis. Yeah,
you're not being double taxed.
So in that example where it was $10,
yeah,
they issued $1.50, and then I reinvested it. My basis is now $11.50.
Right. So when you sell out of this thing, whenever it is, you're going to have a higher basis, which will lower your tax bill by the same amount.
And towards the end of last year, we had some of our bigger clients who have long-standing large mutual fund portfolios. They were looking to the websites for the different mutual funds to figure out what their capital gain distributions are going to be, so that they could do their tax planning before the end of the year, so they could figure out if they had any room to do any Roth conversions. But by November, December, the mutual fund companies all know what they're going to distribute. They tell you what they're going to distribute before they distribute it. So you can find out how much of a taxable event is going to happen. So it's it's happening. You feel a little bit better about it when you actually hear it or see it on the 1099 instead of being surprised by it.
That's the reason we're talking about it.
The surprises are coming up in the next couple of weeks.
I know they are. Well, for some people, I mean, here's the thing: this can get complicated, and I don't know whether or not everybody is able to follow what it is you're talking about. I mean, I know what you're talking about because I've been hearing this for
30
so many years. But I mean, the point is, you said that you do not like to have people.
When I'm doing
mutual
financial
funds
planning, I'm trying to make things as easy as possible and as predictable as possible, as controllable as possible, especially when it comes to taxation. And large positions in mutual funds in non-qualified accounts.
Meaning you own it personally.
Yes, non-qualified, not in a retirement account of some sort, not tax-free, is a wild card. We don't know what's going to happen. And unfortunately, we see some of the biggest capital gain distributions in down years.
Well, we saw it. 22 was huge.
Yeah. A lot of people left the market, and in that case, created capital gains for the mutual funds. When those capital gain distributions were issued out to the remaining shareholders at the end of the year.
Now, as those funds presumably recovered,
they recovered nicely.
Your basis is now higher.
Right. So when I ultimately do sell out of it, I have a little less tax then.
Yeah.
But that doesn't help me this year when I'm paying my dadgum tax bill.
Well, and this was talking about, projecting what your tax bill is going to be. Let's see. I don't really want to get, I know, people have dividends sometimes. They own dividends in their personal accounts.
Well, when we come to and we get an idea of what it is the accounts are actually earning, non-qualified accounts, personal accounts are what we're talking about. Like I said, IRAs, those things are easy. It's only on the distribution.
Yes.
And the distribution is ordinary income. But a dividend has two flavors. A capital gain has two flavors. And those flavors are taxed. They taste different. Shall we say? A dividend can be either what they call an ordinary dividend, and you would kind of figure that, well, that's going to be ordinary income tax, or it can be a qualified dividend. If it's qualified, we get a better tax treatment. We get a lower taxable event. Mm-hmm. Same thing with capital gains. When I sell something for more than I paid for it, that's a capital gain. And there's a difference between short-term capital gains, a year or less, and long-term capital gains.
Can be a big difference depending on how much money you make.
And the tax treatment is very different. For somebody who is basic, and this is not exact, there's about a $200 crossover here, but if it would normally be in the 12% ordinary income tax bracket, and it's gain that falls into that portion of the bracket, you don't pay any tax at the federal level on that gain. It's a 0% long-term capital. Short-term, tax the same as ordinary income.
That's it.
It's just ordinary.
You can maybe offset it a tiny bit.
Ordinary dividends, just like an IRA distribution, qualified dividends have the same tax treatment as long-term capital gains.
Oh, man. Oh.
So looking at these, once you get past the 12%, then my capital gains, my long-term capital gains go to 15%, where the next tax bracket for ordinary income is 22%.
Yep.
And it takes a while before I go into the next tax bracket for long-term capital gains, which is 20%, which by that time I'm in the 35% ordinary income tax bracket. So at all the levels of the brackets, long-term capital gains and qualified dividends are taxed at a lower bracket than these other pension, Social Security, and IRA type distributions.
I tell you, it's I know what you're talking about. My head is swimming. I can't imagine people who are listening and they're saying
every one of these counts towards IRMA.
Well, the
income-related monthly adjustment amount.
Yeah.
And you got to watch out for the net investment income tax if your income's more than 200, single, 250 married.
Oh, that's true. Do you even want to explain what that is? Or do we,
those that I just talked about came out of
Affordable Care Act, yeah.
It's just an additional Medicare tax. It's an additional tax.
Yeah. So, Professor, if I am trying to figure out how much I'm going to pay in taxes in 2025, and I happen to have some of these, extra things, especially as I own them personally. I've got some interest. I got some dividends coming from, dividend-paying stocks or whatever.
Well, the good news is that most of
the time,
what do I
do?
Dividends are fairly stable-ish. If you've got the same holding this year that you had last year, the dividends are going to be about the same.
You hope.
Yeah, hope they don't drop them.
You don't pull a Ford.
Oh,
was
gosh,
it Ford?
That was Ford years ago.
Anyway.
Decades ago. That was a preferred stock, yeah.
Yeah, it was. But even so.
It was a dividend. Yeah. So if we've held it and we're holding it, the bigger one is how much personal money do you have and how is it invested? If you've got $100,000, it's not going to be that big of a deal one way or the other. If you've got $1 million, it's starting to become an issue. If you got $10, $15, $20 million, you've got some tax issues going on. It's much more difficult. Oh, darn. I want that problem, right?
Well, in some ways, you might want that problem.
Yeah, if you've got $10 million in your personal account, you've got a more complex tax situation than somebody that's got $100,000 in their personal account. Go figure.
Well,
first world problem.
Well, again, it's also because so much more money. I mean, it just
there's so many more opportunities. So many, and a 10% distribution on a $100,000 mutual fund, which is a big distribution. Mm-hmm. It's $10,000. Okay, it's not going to make a huge difference in your overall tax bill. A 10% distribution on a $10 million, that's going to leave a mark.
There's $1 million right there, and it will leave a very big mark. Which I think is why, if you're going to try to project what you're paying in taxes, and I do think you need to.
I think you do, because if you don't pay enough, you could be penalized.
Yeah,
and we don't.
I had that problem for years.
We don't want to be penalized. If you don't withhold or pay quarterly installments sufficient to equal what they call their safe harbor.
Yes.
You got a safe place. You got your safe space here. If you don't pay enough, they'll penalize you.
Yeah.
And I've said this many times. I don't like paying the taxes I know I owe. I mean, I'm paying them. I sure don't want to pay more than what I actually owe by paying penalties.
The whole penalty. I mean, it's just that's just like taxes. I just because
it's a waste.
I felt like I was being. I made a mistake.
You did.
And I got to pay a penalty.
But the problem is when you make that same mistake year in and year out.
Yeah, I know.
And you don't fix it. So if you've been in a penalty situation for a couple of years, maybe a couple of weeks ago you should have made the resolution, I need to fix this stupid tax penalty thing.
I said that, I think it was for 7 or 8 years, I would get an $85 penalty from the state because I didn't withhold something. I don't even remember what it was. And I said, I got to fix that. But it wasn't enough for me.
It was a pain, but not enough to make you work.
Nah. I was like, I'll do it next time. And then, here's that $85 penalty again. Yeah. This stuff can get complicated. I hope it wasn't too complicated in this episode because
it can get more complicated.
Well, it is. And I said, we're not going to spend a bunch of time on each one of these things because it can get complicated. But
we didn't get into the difference between an immediate annuity and a systematic withdrawal from an annuity either.
No, we didn't. And I'm inclined
when you have questions on those, give us a call.
Yes, I was just going to say I'm inclined not to talk about it now because if somebody's eyes are, have those little swirly things in them and
they've glazed over,
I just don't want that to happen. The takeaway from all this is it's important to do tax planning early in the year. That's why we're talking about this.
That's
now.
the time to do it. You
can
can't
do something
plan after. In November, December of last year was not the time to do your tax planning for that year.
No,
it's too late in the year to do anything.
Airline pilots will tell you that if you want to know if something's going wrong, find out at 40,000 feet or 35,000 feet as opposed to 1,000 feet because you got time. A
little bit, yeah.
You can make some corrections if you have to.
It's like if you're going to make a course correction, you can make a very small course correction early on. That will make you get to where you want to go. Whereas if you're going off course for 11 months of the year and then you have to correct, you only have a short period of time, you have to make a big correction.
There you go. Boy, listen to these metaphors.
We're just so good at that.
We are. And something else you're good at is financial planning. And you want to talk to any of the Lucia Capital Group advisors about your tax situation. Give them a call, 800-644-1150, 800-644-1150. I keep saying it sounds complicated, and actually it is in many ways. I tried to make it somewhat uncomplicated here. Don't know if that worked. But what this shows is the importance of having somebody who understands how this stuff works. And it may not seem like a big deal in January when you make certain little corrections. But as Professor Plum just said, over the course of 10, 11, 12 months, this can make a big difference toward the end.
Well, you can get way out of whack.
You really can. And if you're trying to do this in December, it's probably...
And what was that old saying? The definition of insanity is doing the same thing over and over and expecting a different result.
Yeah.
Paying a penalty every year in and year out and not fixing it and expecting a different result.
It was $85. I know what you're
over
saying.
10 years, that's $850. And come on.
No, don't say that. I think it was only about 6 years, but whatever. I get it. What could I have done with that money? Give them a call. As I said, 800-644-1150. They love this stuff. Professor Plum loves to do this stuff. I don't know why. I'm sitting here, he's getting all excited talking about taxes, and I'm thinking, why?
There's something wrong with
There is something
very,
wrong.
very wrong.
We said we're not in the normal, when you discuss what's normal, this is not normal. You can go online as well, luciacap.com, LUCIACAP.com. Find all kinds of blog posts, videos. We've got our guides. Let's not forget those. Social Security Guide, the Retirement Planning Guide, Bucket Strategy Guide, Estate Planning Guide. There may be one or two others. Ask us if you can't find them, but you just type them in the search bar.
I was just thinking, this is actually a good time to review your you talked about Estate Planning Guide. To review your beneficiaries. You've just gone through the You've just gone through the holidays with your relatives and everybody in your family. You know who you want to cut out of your will now and who you want to include.
That was Professor Rick Plum saying that, folks, the certified financial planner professional, no less, who just says,
you know who you want to leave your money to.
That's true. I'll leave it at that. LuciaCap.com. Subscribe to this podcast. That's the other thing you got to do. Even if some of the stuff we talk about is complicated, I think you will come away a little bit smarter each week, as I always do, when you listen to this stuff. Apple Podcasts, Spotify, subscribe, download it automatically to your device, and never miss a single episode. It's been a fun start to the year so far, Professor Plum. I ask people too. Oh, we had. Speaking of estate planning, maybe you answered him already. There was a gentleman who emailed with a pretty good question on estate planning that I may want to turn into an episode.
Well, we can talk about it next week.
Yeah. And I know, because we tape these well in advance, if you email us and we don't answer it on the air, for a couple of months, that's why. That's why. I just didn't want anybody to think that we had forgotten it. But this may be, speaking of estate planning, a topic that we get to, if not next week, maybe the week after that. So my thanks to you, Professor Plum. I know you got work to do. I appreciate this, as always. And our thanks to our many listeners. We had they'd listened to our 200th episode of a few whatever it was weeks back, and we finally got some notes on that. So that was nice.
Did, okay.
Yeah, just a little congrats. So
they enjoyed the fanfare that we created for that 200th,
which was like nothing. But it was a darn good episode. All right, for Professor Rick Plum, certified financial planner professional, I'm your podcast host, Johnny Dean. This has been Managing Your Financial Future. Can't wait. We will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and the 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Fixed index annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Variable annuities are considered complex investment products. They contain unique features, risks, terms, conditions, fees, charges, and expenses. Before investing, carefully consider a variable annuity's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Variable annuities with guarantees are available through optional riders at additional cost. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Before investing, carefully consider an exchange-traded funds or mutual funds investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Schwab is not affiliated with or endorsed by LPL Financial or Lucia Capital Group.